next thing you need to do to optimize your exit is to diversify your investments. Now, often if you've worked for the same company for years, you might have accumulated lots and lots of company stocks in RSUs and ESPP plans. In general, it's best to diversify the stocks right away as soon as they vest. The reason is because there's mountains of evidence that shows that it's a really bad idea to invest in a single stock. Remember Intel of the 2000s or even Cisco? Both of these companies were hailed as the next big thing back in the early 2000s, but their stocks are doing pretty poorly now. So in the same way, your company might be doing really well today, but you don't know what the future holds for them. So again, it's best to diversify it right away. However, for some clients I know, they have accumulated millions and millions of dollars in their stocks, and sometimes they feel that the stock is going to keep going up and they want to hold on to it. If that's the case with you, I suggest doing something called a gap analysis. A gap analysis helps us figure out what is the minimum amount you need to diversify from your company stocks so that those goals and priorities that you have for yourself is secured regardless of what happens to your company. So we do a financial plan taking into account all of your goals, all the short-term and long-term goals, as well as all the life milestones like buying a house, buying a second house, etc., sending kids to college, etc. And then after that, we take that equity compensation or that company stock away from the plan to see how it fares. Most likely the plan will fail at that point because you're taking a big chunk of your asset away from it. And that shortfall tells us how much money you absolutely have to protect at any cost in order to meet all your priorities, all your life priorities and goals. And this is the minimum amount that we must diversify in order for your financial plan to work. And that is the gap analysis that shows us how much we need to diversify. Now, once we do that, we still have to figure out what the most tax efficient way there is for us to diversify diversify your company stock. And we'll talk about that next.